You've been told your whole life that you need money to make money, that investing is for rich people with thousands of dollars sitting around. 8. That you should wait until you have more saved up before you even think about it. So you watch your friends who have higher salaries start investing while you're stuck on the sidelines with maybe $50 or $100 in your account after bills, thinking there's no point in even trying. But here's what they don't tell you. Some of the wealthiest people in the world started with almost nothing. The difference wasn't how much they had to begin with. It was that they started anyway, with whatever they could scrape together, and they let time do the heavy lifting. The truth is, you can start investing with as little as $5, and in this video, I'm going to show you exactly how to do it, step by step.
Ow.
Even if you're completely broke right now. Let me start by destroying the biggest myth that keeps people from investing. You do not need thousands of dollars to start. That might have been true 20 or 30 years ago, when you had to call a broker on the phone and pay huge commissions just to buy a single stock. But the world has completely changed. Today, there are investment platforms that let you start with literally $1. No minimums, no commissions, no barriers. The game has been democratized in a way that's never existed before. And if you're not taking advantage of it, you're leaving money on the table. So let's talk about the reality of investing with little money and why it's not only possible but actually a smart move, even if the amounts feel tiny. The most important factor in building wealth through investing isn't how much you start with. It's how long your money has time to grow. This is because of compound growth, which Einstein supposedly called the eighth wonder of the world. When you invest money and it grows, you earn returns not just on what you originally put in, but also on the growth itself. Let me paint a picture for you. If you invest just $50 a month starting at age 25 and earn an average return of 8% per year, by the time you're 65, you'd have around $170,000. But if you wait until you're 35 to start investing that same $50 monthly, you'd only end up with about $75,000. That 10-year delay costs you almost $100,000, even though you invested the exact same monthly amount. Time is the secret weapon, and when you're starting with little money, time is actually your biggest advantage because you're young and you have decades ahead of you. Now, let's get into the practical side of how you actually invest when you don't have much money. The first thing you need to do is open a brokerage account, and I'm going to recommend specific types that work best for small investors. Apps like Robinhood, Webull, and Public have 0 account minimums and 0 trading fees. Traditional companies like Fidelity and Charles Schwab also eliminated their minimums and fees in recent years. Any of these will work, but for someone just starting out with small amounts, I'd lean toward the simpler apps or Fidelity, which offers fractional shares and has great educational resources. The account opening process takes maybe 10 minutes. You'll need to provide basic information like your name, address, social security number, and link a bank account. Once you're approved, which usually happens within a day, you can transfer money in and start investing. Here's where it gets really interesting for people with limited funds. Most of these platforms now offer fractional shares, which means you can buy a piece of a stock even if you can't afford a full share. Let's say you want to invest in Amazon, but one share costs $3,000. With fractional shares, you can buy $10 worth of Amazon, which would give you a tiny fraction of one share. This is a game changer because it means you're not limited to cheap stocks. You can invest in the best companies in the world with whatever amount you have. You could put $20 into Apple, $15 into Microsoft, and $10 into Google, building a diversified portfolio with just $45 total. This wasn't possible for regular people until very recently. But here's my honest recommendation for most people, starting with small amounts. Don't try to pick individual stocks. Instead, invest in index funds or ETFs. An index fund is basically a basket that holds hundreds or thousands of stocks all at once. When you buy one share of an S&P 500 index fund, you're getting tiny pieces of the 500 largest companies in America. The beauty of this is instant diversification without needing to research companies or try to pick winners. And because these are funds and not individual stocks, they're typically less volatile. Some popular ones you can look into are VOO, SPY, and VTI. These track either the S&P 500 or the total U.S. stock market. The expense ratios, which are the fees they charge, are incredibly low, like less than 0.1% per year. Now, I know what you're thinking. I'm only investing $20 or $50. Does it even matter? The numbers feel so small that it's hard to get motivated. I completely understand that feeling, but let me reframe it for you. Every single dollar you invest today is a soldier working for you in the future. That $20 invested today could be worth $60 or $80 in 20 years. And more importantly, you're building a habit that will serve you for your entire life. The person who starts investing $20 a month and sticks with it will almost certainly end up wealthier than the person who waits until they can invest $500 a month but never actually get started. Consistency beats large amounts every single time. Let me give you a real strategy that works incredibly well for people with limited money. It's called dollar cost averaging, which is just a fancy term for investing a set amount on a regular schedule. Let's say every time you get paid, you invest $25. Some weeks the market will be high, so your $25 buys fewer shares. Other weeks, the market will be lower, so you buy more shares. Over time, this averages out, and you end up with a pretty good average price without trying to time the market. The magic is in the automation. Most platforms let you set up recurring investments. So the money gets automatically transferred from your bank account and invested without you having to think about it. Set it up once and forget it. This removes the emotional decision-making and keeps you consistent even when the market is scary or you're busy with life. Here's another angle that helps when you're working with small amounts. Focus on percentage gains, not dollar amounts. If you invest $100 and it grows to $110, that's a 10% return. If someone else invests $10,000 and it grows to $11,000, that's also a 10% return. You both did equally well as investors. The person with more money made more dollars, but that's only because they had more to start with, not because they invested better than you. When you're starting small, celebrate the percentages. Track how your portfolio is growing relative to what you put in, not compared to people who started with more capital. Your journey is your own. Let me also talk about finding money to invest when you feel like there's nothing left after bills. This is where most people get stuck. They say they want to invest, but after rent, food, utilities, and everything else, there's nothing remaining. I get it, and I'm not going to pretend that budgeting is easy or fun. But here's the reality. If you're serious about changing your financial future, you have to find something to cut or some way to increase your income, even slightly. Maybe it's skipping one takeout meal a week and investing that $25 instead. Maybe it's selling stuff you don't use on Facebook Marketplace and investing the proceeds. Maybe it's picking up one extra shift a month or doing a side gig for a few hours and dedicating that money to investing. I'm not saying deprive yourself of all joy. I'm saying look at your spending honestly and ask yourself what you could sacrifice for your future self. Sometimes it's not about cutting, but about prioritizing differently. That new shirt you were going to buy can wait. Your future can't. There's also the psychological benefit of starting to invest, even with tiny amounts. Once you have skin in the game, you start paying attention. You become more financially aware. Start learning about how the market works, about different companies and sectors, about economic news. You're no longer an outsider looking in. You're a participant, and that shift in mindset is valuable in itself. I've seen people start by investing $10 a week, and within a year they're investing $100 because they got raises, cut expenses, or found side income specifically because they became motivated by seeing their investments grow. One thing I want to address is fees and taxes, because these can eat into your returns when you're working with small amounts. The good news is that most major platforms have eliminated trading fees, so buying and selling doesn't cost you anything. But you still need to be aware of expense ratios on funds. If you're investing in index funds with expense ratios under 0.1%, you're good. Avoid funds with expense ratios over 0.5% because those fees compound over time and reduce your returns. As for taxes, if you're investing in a regular brokerage account, you'll pay capital gains taxes when you sell investments for a profit. But if you qualify for a Roth IRA, that's an even better option. With a Roth IRA, you invest money you've already paid taxes on, and then it grows completely tax-free forever. When you retire and take the money out, you don't owe any taxes on it. The contribution limit for 2026 is $7,000 per year, but you can contribute whatever amount you want up to that limit. Even if you can only put in $50 a month, that's still $600 a year growing tax-free. That's an incredible advantage over time. Let me walk through a specific example of what investing with little money might look like in practice. Let's say you're 23 years old and you decide to invest $75 per month. You open a Roth IRA with Fidelity and set up an automatic monthly investment into an S&P 500 index fund. You don't touch it, you don't panic when the market drops, you just keep investing that $75 every month. Fast forward 40 years to when you're 63. Assuming an average annual return of about 8%, which is roughly what the stock market has historically returned, you'd have around $260,000. You personally contributed only $36,000 over those 40 years, but compound growth turned it into $250,000. That's the power of starting early with small, consistent amounts. Now, I need to be realistic with you about something. Investing small amounts won't make you rich quickly. You're not going to invest $50 and retire next year. This is a long-term strategy for building wealth gradually and sustainably. You will see your account balance stay small for a while, and that's okay. You're planting seeds. Trees don't grow overnight, but they do grow, and eventually they provide shade and fruit. Your investments are the same. Give them time. Another strategy worth mentioning is taking advantage of employer retirement accounts if you have access to them. If your job offers a 401k, especially with any kind of employer match, you should absolutely contribute enough to get the full match. An employer match is literally free money. If they match 50% of your contributions up to 6% of your salary, and you make $30,000 a year, you should try to contribute $1,800 annually to get the full $900 match. That's an instant 50% return on your money, which you'll never beat anywhere else. Even if you can only afford to contribute enough to get some of the match, do it. Start with 1 or 2% of your paycheck if that's all you can manage, and increase it by 1% every time you get a raise. Let me also address a fear that holds people back. What if I invest and the market crashes right after? This is a legitimate concern, and the truth is it might happen. Markets go up and down. If you invest $100 today and next month, the market drops 20%, your $100 might be worth only $80. That feels terrible, but here's what you need to understand. You haven't actually lost money unless you sell. If you just hold on and keep investing, you're buying more shares at lower prices. And when the market recovers, which it historically always has over long periods, you'll be better off than if you had never experienced the dip. The absolute worst thing you can do is invest money, watch it drop, panic, and sell at a loss. That locks in the loss and takes you out of the game right before the recovery. This is why you should only invest money you won't need for at least 5 years, preferably much longer. Short-term volatility becomes irrelevant when you're thinking in decades. I also want to give you permission to start messy and learn as you go. You don't need to understand every financial concept before you invest your first dollar. You don't need to have a perfect plan. You don't need to wait until you've read 10 investing books. Just start. Open an account, invest a small amount in a broad index fund, and learn by doing. You'll make mistakes, and that's fine. The stakes are low when you're working with small amounts, so this is actually the perfect time to learn. As you gain experience and confidence, you can refine your strategy. But the important thing is to begin the journey. One last piece of advice. Protect yourself from lifestyle inflation. As you earn more money in your career, it's tempting to spend more on everything. Nicer apartment, fancier car, more expensive dinners. If you let your spending increase at the same rate as your income, you'll never get ahead. But if you can keep your lifestyle relatively stable and invest the difference as your income grows, that's where real wealth gets built. The person making $40,000 who invests 15% of their income will end up far wealthier than the person making $100,000 who invests nothing because they spend it all. Before I wrap up, I need to mention that everything in this video is for educational purposes only and not financial advice. I'm not a financial advisor, and your situation is unique. You should do your own research and consider consulting with a professional before making investment decisions. But my goal here was to show you that investing with little money isn't just possible. It's a powerful wealth-building strategy if you stay consistent and give it time. So here's what I want you to take away from this. Don't wait until you have more money to start investing. Start with whatever you have right now, even if it's just $5 or $10. Open an account this week. Set up automatic investments, even if they're tiny. Choose a simple, low-cost index fund that gives you broad diversification. And then commit to consistency. Keep investing every month, no matter what. Ignore the short-term noise, stay focused on the long term, and trust that compound growth will do its thing over time. Your future self will thank you for starting today rather than waiting for some day that might never come. If this video helped you realize that you can start investing regardless of how much money you have right now, I'd appreciate it if you hit the like button. And if you want more practical advice on building wealth, investing smart, and achieving financial freedom, subscribe to the channel. In the next video, we're going to talk about the biggest investing mistakes that cost people thousands of dollars and exactly how to avoid them. Thanks so much for watching, and I'll see you in the next one.